Hey there, everyone. Happy Monday, November 4th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a overcast, we'll call it, Redmond, Washington. Thanks for joining me every weekday after the close as we break down the market action using the best practices of technical analysis. Oftentimes I get asked, what is this stock going to do? What are the markets going to do? Where is XYZ going to be 3 months down the road? I really don't know the answer, to summarize. And I will be honest with you, no one does either. None of us can tell the future. And I think a lot of people, when they're learning technical analysis, they think of it as fortune telling. They think of it as reading the tea leaves, sort of having this idea. And there are certainly parts of the technical toolkit that don't help to, resist that general connotation, right? They sort of try to project levels and particular turning points and all of that. I would argue the way that most institutional investors, most successful investors that I've worked with, most traders that I've worked with that are able to use technical analysis effectively, it's not about predicting the future. It's about understanding the market environment. It's about understanding trends. It's about measuring momentum and breadth and volume, all those sort of building blocks of investor psychology that really reflect on what investors as a general community are doing. And recognizing that trends tend to persist. So it's less about predicting the future and more about consistently analyzing the past and the trends and being a market historian. I've had some really good conversations recently, by the way, on the Market Misbehavior podcast. My conversation with Ari Wald last week had a lot of great feedback. I'd encourage you to check that one out. It's sort of like a mini masterclass on trend following and market awareness and market history. Did a lot of looking at previous cycles and recognizing what sort of consistent patterns we could find, what it tells us about the current market environment going forward. Just a little while ago, released our latest episode of the Market Misbehavior podcast, probably episode 8 or 9. I should probably know because it's not that many, but I tend to lose track of those kind of things. With Adrian Day of Adrian Day Asset Management. Adrian is an economist and money manager. He runs his own firm called Adrian Day Asset Management. Also works with Peter Schiff, who I interviewed earlier in my podcast series. Adrian is just a warm and generously thoughtful economist. Really had some great answers to questions about inflationary pressures and economic data and risk management, top-down versus bottom-up investing. A lot of really good kind of foundational, how should we think about things kind of questions about the elections and so forth. So please do yourself a favor and check out my recent conversation with Adrian Day and all the others that building up quite a great library of fun conversations. Got a lot of good plans to keep those conversations going. I would love to know who else we should interview as part of that podcast series. So please drop a comment, let me know. By the way, we are streaming our market recap today on Facebook, on LinkedIn, on YouTube, and on X. So I appreciate you wherever you're tuning in from. I can see comments that you put on any of those platforms during the live stream. So put questions as they come up. At the end, I'll try to take a question or two. Anything I don't get to, we will put in the Chart This mailbag. And on Friday's show, I believe this week, we'll share some results. Going to be a kind of an interesting week. Obviously, we've got the elections coming up tomorrow. Hopefully, we get some resolution to the elections tomorrow evening. The risk, I think, for many of us having gone through the last couple of elections is a, sort of a lack of clarity in terms of who the victor is, and then it sort of dribbles on. And generally speaking, the market likes certainty. The equity markets do not appreciate uncertainty. So I would say a still contended election after tomorrow night, probably not going to be great for stocks until we sort of know the eventual victor and what sort of administration we're going to have. With that in mind, let's get to the market recap and see how the markets played out today. So here's sort of your normal playbook the day before a big news event, like a Fed meeting, like an election. Obviously, this is a highly contested election, super unclear as to who the victor will be. Poll data is kind of all over the place. There you will see and hear people swearing that one candidate has a clear, path to victory. But at the end of the day, it is very much sort of a coin toss at this particular moment. That's why the markets don't have necessarily a ton of conviction. One would argue sort of pricing in a Trump presidency with the optimism about business conditions going forward, but hard to say. At the end of the day, we'll have to see how things play out. But normal playbook on the day before a big election day like this, is quiet, lighter volume, not a lot of movement, sort of wait and see mode. Now, we do have a lot of earnings. So underneath the hood, even though the major benchmarks down slightly from Friday's close, but not sort of a huge sell-off. And parts of the market like small caps are actually were actually up today. It's more about sort of the general feeling is going to be pause. I would expect tomorrow to be sort of lighter as well until we see how the election season sort of plays out. Having said that, the S&P 500 down about 0.3% today to 5713. The Dow leading the way further down about 0.6%, just below 41,800 at the end of the day today. The Nasdaq Composite down about 1/3%. Worth noting, mid caps and small caps both actually in the green. And when I talked with Ari Wald last week, we talked in particular about small caps as an area to focus on. I mean, generally speaking, if the markets really sort of continue to the downside, following through on some of the warning signs that we've been talking about on the show in terms of breadth conditions, volume conditions, momentum sort of slowing down, small caps most likely lead the way lower. That's kind of the classic playbook for a major market top, because small caps tend to be more risky, more higher beta. So if we're concerned about the market going down, usually sell those sort of speculative positions. You get into big defensive positions to ride things out. At least that's what an institution would do. That usually means small caps go down first, mid caps follow, and the large caps usually hold up because that's where you rotate to. And then when those start going down, that's when you know it's sort of a disaster, sort of doomsday scenario. But for now, small caps actually up today, right? Up about 0.5%. So very much sort of a treading water, wait and see mode for the broader markets. The VIX, of course, still above 20. And again, in this kind of environment, we've seen the VIX generally trending higher with some significant spikes above 20, even in July, August, well above 20. However, there's the general trend in the VIX has been going higher, while the general trend in the S&P has been going higher over the last 6 weeks as well. Usually when that happens, the VIX ends up winning that battle more often than not. And stocks usually sort of, eventually sort of have to deal with the excessive volatility, which usually means excessive fear and uncertainty, which usually means equity prices going down. So VIX remaining high certainly tells you uncertainty is elevated. That's definitely what it feels like for me as a registered voter in the U.S., waiting to see how things play out and what sort of things we might have to look forward to over the next 4 years or so. All right, looking at interest rates, we have the 10-year, 5-year, 30-year points all down, not a ton, but down a little bit. The 5-year yield around 4.17, we'll call it. The 10-year yield finished slightly above 4.3%. The long bond yield above 4.5%. The dollar slightly lower, about 0.4% lower. Bond prices moved higher through the course of the day today. Of course, we also have the Fed meeting. We talk about a crazy week where the Fed and another most likely rate cut is sort of like a forgotten, it's sort of like this other thing way down the list after you have a bunch of earnings and, a major U.S. election. But the Fed meeting, not a lot of drama expected there in terms of the change. It's pretty much 100% priced in. It's a 25 basis point cut, and that's what I would expect for sure, most likely. But the question is going to be more about the pace of future rate cuts, right? Going into the beginning of next year and sort of the Fed dot plot, which is where the different governors sort of have a projection about where interest rates may be going to. That's what you want to really focus on in terms of the evidence and the comments, and the press conference with Powell will most likely dig into those themes pretty closely. Precious metals doing okay. And I mentioned my conversation with Adrian Day. We talked about gold and precious metals and how to think about them relative to other asset classes. He was fairly constructive, pretty bullish on gold and silver prices today. You're seeing more upside there. Energy prices, especially in the green today, with crude oil using the USO up over 3%. Natural gas ETF UNG was up almost 5% today. Cryptocurrencies, boy, continuing to just be choppy, sloppy. Bitcoin, reached 70,000. I feel like a long time ago. It hasn't been that long, but it feels like months and months ago. And we've just been struggling to sort of get a foothold above 70K. Big round numbers tend to be pretty important in a lot of markets, but especially in cryptocurrencies. I've seen that with the chart of Bitcoin, as we've mentioned many times before. Here's just another time where that 70,000 sort of general level has repelled a potential advance. For now, Bitcoin currently trading around 67,400. And to be clear, do own Bitcoin and Ethereum on my own accounts. Full disclosure. All right, looking at the 11 S&P sectors here, and just to give you a heads up on what we're going to do here, we're going to look a little bit at finish the market recap. We'll look at the market carpet, but then focus on some individual charts, some macro charts to pay attention to today, given sort of the, it's sort of a macro week. Although, again, some individual companies reporting earnings. We'll highlight a couple of those like Franklin Resources, CEG, Cardinal Health, that I think are worth charts worth reviewing. But generally, it's just more like a macro week as you think about sort of the elections and the Fed meeting. Some of the conditions certainly have been deteriorating. We'll talk about some of the charts that I was highlighting for my Market Misbehavior Premium members in our main weekly report that comes out every weekend. But let's continue on looking at the sector. And then the other thing I was going to say is I want to just go through rapid fire those 8 sort of Magnificent 7 and Friends groups, because none of those 8 charts are particularly bullish at the moment, right? They're not bad, right? They're not a lot of ugly. They're not a lot of bad charts, just not as many good charts, right? I mean, pretty much every one of those mega cap growth stocks has had a failed breakout in the last couple of weeks. And I think that is a very telling feature of the current market environment here in early November of 2024. For what it's worth, sector-wise, 4 of the 11 S&P sectors finished in the green. Energy, number 1, up 1.7%. Real estate, number 2, it's a pretty defensive sector, up 1.2%. Materials, number 3, up 0.4%. On the downside, utilities, which hard to tell these days whether it's a growth sector or a defensive sector, but down 1.2%. Financials, number 2, down 0.8%. Some earnings weighing on the sector there today. And then healthcare down 0.6%. Want to highlight our market trend model, which we formally update every Friday after the close. As of last Friday, did turn bearish in the short term for the S&P 500, also for mid caps, small caps, and the Nasdaq 100. I'll show you the chart in the chart review just so you can see what that actually means. I did record a video earlier today for Stock Charts TV, so you go to the Stock Charts YouTube channel. My weekly show comes out every Monday. I'm not sure if it's posted just yet, but if not, hopefully very soon. And I talk a lot about the market trend model, how it's constructed, how you can access it. So make sure you check that out. Should be posted soon. And if not now, very soon from now. All right. Looking at the mega cap growth leadership names, NVIDIA, the lone of these 8 stocks moving higher, 0.5%. NVIDIA is still not breaking out, but at least not going down today. Tesla, your worst performer, down 2.5%. Alphabet, Meta, Amazon, all down just over 1% today. All right, let's look at the market carpet again. I love heat map visualizations like this that give you just sort of a great sort of top-down and bottom-up perspective on stock performance over different time periods. I use this on all sorts of different time periods to sort of think about different secular versus tactical trends and everything in between. Today we're just looking at 1 day's performance. So from Friday's close to right now, after the U.S. market close, what did we see? Step 1, let's look at the overall landscape. Pretty mixed, right? And I would say you can see things that were down, like Tesla, stands out, down about 2.5%. But for every Tesla, I feel like there's an Exxon Mobil up about 3%. Exxon and Chevron, 2 energy stocks, reporting earnings on Friday of last week and having a nice bounce today. Noticing some of the larger names, one of the interesting patterns, some of the largest names in like healthcare, in financials, and consumer discretionary, some of the worst performers, right? I mean, if you look, you sort of see the largest names kind of neutral to red, but then elsewhere in the sector, you're seeing opportunities. So this is one of those where kind of like the mega cap struggled relative to smaller. And you saw that on that during the market recap with small cap Russell 2000, S&P 600 kind of ETFs up about 0.5%, while the S&P and Nasdaq were slightly lower. Within technology, obviously the biggest names not really particularly strong, up slightly, but there were areas of the market, particularly renewable energy like Enphase, up about 4, almost 5%, SolarEdge up 3.5%, First Solar up 3.5%. But all of those last week had a pretty brutal week. These are all bouncing off of pretty significant weak points of weakness. So not like great stocks breaking out. These are stocks sort of rebounding after a deterioration. It almost looks more like a dead cat bounce as opposed to labeling it some sort of broad recovery just yet. We'll see if they continue to improve, but overall not particularly strong. Also want to point out a lot of weakness in the airline space. Airlines have been one of the more compelling groups, certainly in the month of October. You saw airlines sort of have this great resurgence, but today I'm seeing Alaska down 4%, American, UAL, DAL, all of those down 2.5 to 4+% today. Southwest as well down just over 2%. So a lot of those sort of leadership names within industrials kind of coming off a little bit. That's sort of how I would summarize my take on the MarketCarpet sort of top-down visualization. All right, let's continue on here with the chart review. As a reminder, I can see questions you pop in on whatever platform you're on. So if any questions come up during the show, pop them in the comment section of whatever platform you're seeing this on. I'll try to take a question or two at the end of the live stream. Anything I don't get to, we'll put it into the stock charts. Excuse me, the chart this mailbag for Friday's episode, I hope. All right, let's look at the S&P 500 daily chart. As we highlighted last week on Thursday's show, we did gap below that trend line. That trend line is one we've been following for quite some time. That's the early August low, early September low. That lines up pretty well with where we were hitting sort of in the last couple of weeks of October. You can see Thursday of last week, we gapped below that trend line. And as I talked about, right, that trend line, for me, it's not a trading system. I probably wouldn't take a particular action based on a trend line break. But for me, it's a great visual representation of the pace of a trend. And when we break that trend line, that just tells me, at the very least, something's different. This is probably a change of character. Whatever trend was at work going into that point is something's different coming out the other side. Sure enough, we gapped down to the 50-day moving average. Friday, we kind of chopped around and had a bit of a weaker day as we finished near the lows. Today, we traded slightly below the 50-day. We did close back above it. For me, the 50-day is part of a sort of conglomerate of support levels around 5,650 to 5,700. You've got the 50-day moving average. We have the early October swing low. So again, as long as we hold kind of 5,670, you could still say we're making higher highs and higher lows. We break that. You can't say that anymore, right? That's the classic Charles Dow definition of an uptrend. That's why that level is pretty important. Then 5,650 is the pivot point from July and August. Those are the highs. See how they all line up right around that same level. That's a potential support level going forward. So S&P below 5,650, I would argue, sort of a much more much less constructive, much more bearish structure to the short-term phase as well. And the fact that our short-term market trend model turned bearish on Friday is, I think, part of that change of character that we're observing. I wouldn't be surprised if we go much further to the downside after this. Again, a lot of open questions that will need to be answered between Tuesday and Wednesday, the Fed meeting, elections, all of that, of course. But from a technical perspective, I would say the initial signs of distribution certainly are playing out. The question is, do we get that follow through? And again, we'll look at some charts that sort of make of that a little more clear in terms of what we're looking for. I mentioned the market trend model. This is a model that I've been managing for years, and it's a simple model based on a bunch of moving average comparisons. I had lunch last week with Tom McClellan, so shout out to Tom and his followers at the McClellan Market Report. He's been writing that newsletter for years, and he's actually sharing with me some stories of early days of writing the newsletter, literally printing it out, taking it to a printer, folding it, putting the stamps on, and just talking about the logistical challenges of being a newsletter publisher, 20 years ago, 20 plus years ago. It was a lot of fun just talking with Tom about the markets and about life and a lot of other things. But anyways, the reason why I bring that up is the McClellan oscillator, which we talk about often, is based on a different methodology, but same idea of making moving average comparisons. They're doing it with the McClellan oscillator, doing it on advanced decline data. Here we're just using it on the S&P 500. But when the short-term model turns bearish, that means at least we're in a pullback phase. And so that's what I have to consider this as of Friday's close with the short-term model turning negative. Keep in mind our medium-term model, which for me is my main risk-on, risk-off model, is still bullish. The long-term model has been bullish for over a year and a half. So for now, I'm labeling this as a pullback within an uptrend, similar to previous pullbacks we've had in April and in July and in August. However, if and when we would get a breakdown of the medium-term model, that tells me we're at least into more of a multi-month kind of deterioration, if not something even more painful. So for now, that's not what I'm watching, given the fact that the short-term model did turn briefly negative. And again, I did post a video earlier today, hopefully is out now, or if not, very, very soon on the Stock Charts TV YouTube channel. my weekly show every Monday. The VIX is above 20, and that's a bit of a warning sign for me. VIX above 20 is high volatility. VIX below 20 is low volatility. Can the market go up on higher volatility? Of course it can. Is it much more common for the market to be going down when the VIX gets high and remains elevated? Yes, that is way more common. That's why we look for spikes in the VIX spikes in the VIX as a sign of uncertainty and elevated risk of the market deteriorating. We've had a number of spikes above 20 in the last couple months. Every one of those have come back below 20 within a week or two. We'll see if we remain in a higher volatility environment. It's kind of what happened in 2022, by the way, is you had to push above VIX 20. It kind of remained up in that elevated region for quite some time. You know, we highlighted chicken money flow and had a great time on the IBD live podcast last week. What a great group of people. We had so much fun. I mean, they're just the nicest people. A lot of fun to talk to, and enjoyed it as always. And this is one of the charts that I shared there. If you caught our discussion, I talked about chicken money flow. This is a measure of volume trends and basically recognizing when there are signs of distribution in a stronger market. When you have the market going higher, you want to see higher volume. You want to see signs of accumulation, which means the market, buyers buying and pushing the price higher on heavier volume. And that's what the chicken money flow above zero kind of tells you. Toward the end of a bull market phase, you often have a divergence where the market's going higher, but the chicken money flow slopes downwards. And if you know the calculations, it's all about where we close every day versus the high and the low range. So if you have the market going higher, then you have big distribution days where the market's closing at the low. So even though the trend is still up, we have these individual days with weaker closes and the volume is strong enough, that starts to change and give you these divergences. And we noted that earlier in the month of October. Fast forward to the last couple days, and it has gone below zero. In the last 1, 2, 3 times it has gone below zero after spending quite a bit of time above zero. It's been the beginning of a pretty decent pullback, most recently in July and in April of this year. So again, a lot of signs sort of pointing to the fact that we're in a bit of a distribution phase. Again, that is the technical backdrop. Now we have a lot of macro news sort of related things to digest, but for what it's worth, I would argue the market's sort of in a general position of weakness from a technical perspective. Not long-term weakness, but short-term weakness for now, right? All right, let's finish off looking at some individual names. Again, pop some questions in if any come to mind, and I'll grab one or two here in a few moments. I want to talk about Cardinal Health flashing the classic candle pattern. Do you know what this one is? If you don't, this is a classic, common pattern at market tops called the bearish engulfing pattern. That's where you have a big up day, a big down day, day two's range engulfs day one's range. When you're talking about candle patterns, you use the body of the candle, which is the open to close range. So that's literally like the body, what's called the real body of the candle. So here we have the up day on Friday, open to close. We have the higher open today, but the weaker close. So that suggests short-term weakness. And this is after, as that's testing the high from October and September. So a bearish engulfing pattern, a bearish candle pattern at a well-established resistance level usually is a pretty high probability that we're going to have further deterioration from here. Next 1 to 3 bars, it's all it's really suggesting, but I'm looking for a retest of those late October lows, given that distribution pattern that we saw today. Interesting day for Franklin Resources. This is one of the asset managers that we've talked about at times through the course of this year. It's been an interesting kind of nice recovery off of the September low, higher low in early October, higher high later in October, and then we sort of continued this pattern up until today, where we did trade slightly higher, but we also undercut the October low all in one session. By the end of the day, we did close just above the 50-day moving average, but this is really sort of a model of consolidation. This is a stock still very much an open question as to which side is taking control here. I'd want to see it get above 21 and hold that as a sign of upside follow through. They reported earnings earlier today. You really didn't get that follow through. You actually got more deterioration than anything. So I would say a less than ideal reaction to today's earnings result. Constellation Energy, ticker CEG, is one of the utility names we've referenced, given the strength of this pattern, the gap higher that we had in mid-September and the push to new 52-week highs soon after. What's happened now is we had a gap down today on their earnings release, down about 12.5%. What this creates is the dreaded bearish island reversal. This is where you have a gap higher a bunch of price action, then a gap lower. Imagine like you're looking overhead at a map and you have this island sticking off the coast. That's why it's called the island reversal. A gap higher, some stuff, a gap lower. It's pretty bearish because it means whatever was happening to cause that upside jump in the stock is now countered by an equal pressure to the downside, and that's usually a bearish sign for Constellation. So not a great development, and one of the stocks that have been sort of representative of the strength in utilities in 2024. I do want to highlight briefly Home Depot. You know, when I think about a macro week like this, you know, looking at individual charts like Home Depot are important just to sort of understand the risk and reward in a particular stock, but also think about the larger sort of connotations, the larger impact, or the larger, I guess, meaning that some of these pullbacks have. In a bull market, if this is a bull market environment, if I'm supposed to be optimistic about stocks going into the beginning of next year, if this is the time when I should be accumulating stocks, I would expect and I would hope that a chart like Home Depot kind of resolves to the upside, because that would be a classic breakout, pullback, and retest of resistance, retest of an ascending 50-day moving average. That would be the most constructive thing I could see. And if you see a bunch of these kind of patterns where they've broken out and now pulling back and making a higher low before they resume, that would be a great way for the market to look strong in November and December. If on the other side, though, a stock like Home Depot can't hold 390, does not hold that breakout level, does not hold the 50-day moving average, what does that tell you about broader implications about investors unable or unwilling or disinterested in taking on additional risk here? When stocks like this don't hold support where you'd expect it, it doesn't mean good things for the stock, but it also, if you see a bunch of them, can mean broader weakness, sort of like looking at a breadth indicator and recognizing that there's a bit of concern. It's not all bad, though. I will tell you, like in eBay, pulling back to the 38.2% retracement. I see you there. October 23 low around 37. The October 24 high around 68, 38.2% of the way down, right at 56. That was your low from Thursday, then Friday, and today kind of bouncing higher, starting to fill that gap. That is a sign of constructive buyers, of accumulation, of people willing to buy in on a little eBay after a bit of a downdraft earlier this week. First Solar now done with earnings last week, gapping higher today. Again, a lot of these renewable energy names were some of your top performers today. A lot of them are coming off of pretty beaten down levels. I like the fact that you're seeing First Solar back above the 200-day moving average. I would love to see a higher low that would kind of complete that transition from distribution to accumulation. All right, let's rapid fire go through the 8 Magnificent 7 and Friends kind of charts. And at some point, I'll probably add to this list a little bit. But I just want to very quickly note, and this is what I was talking about with the chart of Home Depot. You know, it's interesting to analyze Home Depot just as its own, on its own, as a standalone technical analysis process, but also think about the implications of stocks like Home Depot not holding support. When you have stocks that should hold support but don't, that tells you something about the broader environment. If stocks like NVIDIA do not break to new highs, but instead fail to break out, I think that tells you something too. Now, NVIDIA isn't a horrible chart just yet. We're not too far off of all-time highs that we established about a week and 2 weeks ago. However, I'm noting when I take a step back, this is a failed attempt to get above the June peak, and for now we're stalling out. It's not really breaking down a ton yet, but given the opportunity to break out and break to new highs, was unable to do so. You could say the same for Meta, struggling to get above $600 a share, testing it 3 times in the last month, and now pulling back a little bit. Again, still above an upward sloping 50-day moving average. The RSI is still constructive. That's all good. So again, I'm not saying Meta is a bad chart. I'm saying I'm noting that this is another stock not breaking out. Here we have Netflix with a gap higher on earnings earlier this month, and that's pretty much been it. We've been sideways since then, sort of wait and see mode. Amazon gapped above trendline resistance, and for now failing to get above the July peak. Amazon over 200, pretty constructive breakout. Amazon not getting above 200 just yet. Here's Microsoft trading above trendline resistance and failing back down to a previous support level. Here's Alphabet gapping above a resistance level, completing what I would argue is a pretty clear inverted head and shoulders bottoming pattern. We're actually right back down to the neckline after failing to follow through. Apple, maybe the best example, trying to get above the July peak, just failing to do so and drifting lower. Tesla hitting this level a number of times. So all of those stocks within the last month have had a failed breakout, either getting above some level where it seems like a clear trigger to renew a bullish trend, and it's kind of stalled out and come back afterwards, or with charts like Tesla or Apple or some of these others have hit resistance. And as we've talked about, it's bullish when stocks trade not just to resistance, but through resistance. None of those names have really done so. So I'm going into tomorrow's elections, election day. I'm going into Wednesday's Fed announcement, thinking of these as the backdrop. And I would say the way that you analyze the markets coming through this period, through this kind of macro week, what do investors do with some of these big names? Do you see a resumption? Do you see a breakout? Do you see that follow through that would tell you, okay, we're actually trading through resistance. What's next? Or do we see further deterioration, stocks stalling out, failed breakouts? And I think that's going to tell you a lot about the market conditions to expect over the next 6 to 8 weeks as we get through what's usually a pretty bullish period for stocks. All right, there was my I feel like soapbox moment, talking about a lot of different things. All right, I love this question, Dan, on LinkedIn. Thanks for watching. I appreciate it. Add a 12-month rate of change to the VIX. Enlightening. Challenge accepted. I love that idea. Let's try it. All right, let's go to the VIX chart. All right, and you said 12-month rate of change. All right, so I'm looking at a daily chart here. So I tell you what I'm going to do. I'm going to make this a weekly chart, and I'm going to make this like a 5-year chart, maybe a little bit more. And let's see, rate of change. So I'm going to add rate of change, but I tell you what, I'll just do a 50 week rate of change. It's about a year, 12 months-ish. Interesting. All right, so let's look at the, and I tell you what, let me get rid of this so we can actually see what we're doing. All right, and let's make this a little bit higher. All right, and as you can tell by the fact that I'm just fumbling through all of this, I'm not really thinking about I haven't really looked at this up until now. Interesting, and I think what you're referring to is just looking at, when the rate of change for the last year, and again, I know I'm not doing exactly what you said. This is as close as I can come up with as I try to talk and analyze charts at the same time. It's interesting to me, the VIX kind of getting above and below that zero line, right? Breaking down in 2021, which is pretty kind of a bullish period for stocks, breaking above in 2022, breaking below in 23, really through July, August, and then all of a sudden going positive. So stronger VIX tends to correlate with weaker stocks. That's an interesting way to think about that. What's funny is it's kind of what you're doing. And again, there are a lot of different ways to do what you suggested and what I'm analyzing here. You could argue you can do something similar. You just look quickly at the VIX and the 50-day moving average. And again, not our 50-week, right? When we start breaking below the 50-week, we're in a lower VIX environment. When we break above, so sort of a lagging indicator, using a MACD of the VIX would kind of give you some similar type of thing. Arguably, I love that idea. I think what you're illustrating with that comment, which I really appreciate, is just the change in the VIX and what that means. And that's something we've observed where the MOVE index really started to break out before VIX. That's the volatility of the bond markets before the volatility of the equity markets. And now you're arguably seeing a VIX trending higher over the last couple months. Thanks so much for that comment. That's actually made me something to think about. I'll continue to dig into that time permitting. Final question here, and then we'll wrap the live stream. What difference does it make to use the SMA versus the EMA in charts? That is an epically awesome question, and I will tell you this. I don't know if this is a great example, but I'm going to use it anyways. All right, here is a stock. This is Ben that we looked at earlier. I'm going to look at two moving averages, and I'm going to make the simple moving average blue and the exponential moving average in pink. All right, so here we have two 50-day moving averages. The blue moving average is the simple moving average. The exponential moving average is in pink. The way a simple moving average works is it has a look back period of 50 days, and it's called the moving average because that average kind of moves along, right? So every day you add a new observation, you rolled off an old one, and you have this 50-day window or 200-day window or whatever that just kind of moves along with the price. An exponential average is a little different where it has a weighting to the most recent data, and then it adds that to sort of a running total of the entire history. So it weights the more recent price action more heavily. So a simple moving average, all 50 days have equal importance, right? Because it's adding up the 50 closes and dividing it by 50. And an exponential average actually front weights it. It weights the most recent data a lot more. So what happens is you can see that pretty much 100% of the time, the pink moving average, the exponential moving average, during a trend change, the pink moving average moves first and the simple moving average does not. Trading systems have been built on just looking at the crossover between two moving averages using different settings and different methodologies. But it's based on that known sort of shortcoming of a simple moving average, that it weights a bunch of data points equally. And then there are things like exponential averages, which weight the more recent data more heavily. So my market trend model is built on exponential averages because they're more reactive. When the market changes, the moving averages change more quickly. And then that's important to me if I'm really trying to understand changes in trend. The simple moving averages are good to use because so many people use them. They don't understand the logistics of moving average calculations, but they're easy to calculate. And most charting platforms have them as a default. So that's why using the 50 and 200-day simple moving averages, that's my go-to on a daily chart of a stock like Ben. Awesome question, by the way. I hope that answer helped you make sense of it. And at this point, I will say thank you guys so much for tuning into my show. I appreciate you so much checking out the live stream wherever you're at. If you're watching this on record, I appreciate you as well. Don't forget to drop a comment below any of the questions I don't get to. I will certainly put into the mailbag and hope to answer your question on our Friday show of this week. Have a great rest of your week. Good luck tomorrow with elections. Good luck Wednesday with the Fed. We'll be here recapping the markets every day after the close. And for Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Take care.